Thank you again for allowing me to present at TMC. As you may know, my name is Chris Sant and I work at advisory firm Ryan Tax Services. I've worked for companies in the transport sector over the last 11 years and have been involved in the ATA for the last 6 years. I'd like to firstly congratulate the ATA for its ongoing role in policy and support for the sector, but also TMC for the direct value it delivers to transport operators. We would like 10 minutes of your time today to share an update on temporary full expensing. Temporary full expensing was announced by the federal government on the 6th of October 2020, expanded on the 11th of May 2021, and is part of the federal government's COVID stimulus measures. Temporary full expensing effectively enlarges the scope of the instant asset write-off by not stipulating a maximum cost of assets and by extending eligibility to large business entities. The temporary full expensing measure is summarised as follows. For businesses with annual aggregated turnover of less than $5 billion, you'll be entitled to an immediate tax deduction for the full cost of new depreciating assets and improvements to existing eligible assets acquired from the 6th of October 2020 and first used or installed by the 30th of June 2023. For businesses with an annual aggregated turnover of less than $50 million, you'll also be entitled to an immediate tax deduction for the full cost of second-hand assets acquired from the 6th of October 2020 and first used or installed by 30 June 2023. If the above doesn't apply to you, the assets may still be fully deductible under the instant asset write-off if, for businesses with an aggregated annual turnover less than 500 million and not using simplified depreciation, and the asset cost is less than 150,000 and is purchased by the 31st of December 2020 and installed or ready for use by the 30th of June 2021. Accelerated depreciation may still be available for assets used or installed between the 12th of March 2020 and the 30th of June 2021. This table prepared by the Tax Office is helpful. It shows a representation of the rules and can be found by Googling ATO and tax depreciation incentive. Further, the Tax Office has also published Law Companion Guide LCR 2021/1. These resources are extremely helpful for taxpayers and should be referred to by the transport sector or their accountants when preparing their returns for 2021 and 2022 or making decisions around the purchase of assets and the eligibility under either the temporary full expensing or the other criteria, such as instant asset write-off or accelerated depreciation. These guides are very helpful and are easily accessible by you and your accountants. So what assets are eligible? You can deduct the full cost of assets under temporary full expensing if, the first criteria, the asset is a depreciating asset. A depreciating asset is an asset that has a limited effective life and can reasonably be expected to decline in value over the time it is used. Depreciating assets include items such as trailers, trucks, computers, and motor vehicles. The second criteria, the asset is new or second-hand. You can only immediately deduct second-hand assets if your business's aggregated turnover is less than 50 million. The third criteria, the asset must be held by your business after the 6th of October 2020. The fourth criteria, finally, the asset must be first used or installed or ready for use between the 6th of October 2020 and the 30th of June 2023. There are some excluded assets. These are assets that are excluded from the incentive, which are listed on the slide. Under this incentive, there is no general limit to the amount that you can deduct on the cost of the assets, which is in contrast to the instant asset write-off. However, there is a limit on how much you can deduct on the cost of a car. For the 2021 period, the cost of a car can be written off under temporary full expensing up to the limit of $59,136, excluding GST. You can also deduct improvements to eligible depreciating assets under this incentive if the improvement is incurred between the 6th of October 2020 and the 30th of June 2023. The asset is either an eligible depreciating asset under temporary full expensing or is an eligible asset but was purchased before the 6th of October 2020. We will now show some examples on ways you can work out your deductions under temporary full expensing. Example 1. Slow Transport Pty Ltd has an aggregated turnover of $20 million for the 2021 income tax year. Slow Transport engages in the following transactions. Slow Transport purchases a roller brake tester for $120,000 on the 22nd of February 2021 and immediately uses it wholly for business purposes. Further expenses of $1,000 are incurred on the 31st of March 2021 to improve the performance of the roller brake tester. Slow Transport then purchases a second-hand plasma cutter on the 5th of April 2021 for $2,000 and immediately begins using it wholly for business purposes. As Slow Transport has acquired and used the roller brake tester wholly for business purposes after the 6th of October 2020, it can deduct the full cost of the roller brake tester and cost of improvements in its 2021 return under temporary full expensing. Slow Transport can also deduct the full cost of the second-hand plasma cutter. This is because the aggregated turnover is less than $50 million. Therefore, the total deductions as a result of these transactions in the 2021 tax return are $123,000, with this given as a result of temporary full expensing. Example 2. Tiny's Heavy Haulage has an aggregated turnover of $60 million in the 2020 and 2021 income tax years. Tiny's Heavy Haulage engages in the following transactions. On the 8th of September 2020, Tiny's Heavy Haulage acquires a new drop trailer for $50,000 and immediately begins using it wholly for business purposes. On the 1st of January 2021, Tiny's acquires a second-hand wheel alignment machine for $40,000 and immediately begins using it wholly for business purposes. On the 2nd of February 2021, Tiny's incurs costs of $1,000 to improve the wheel alignment machine. Tiny's cannot immediately work out the decline in value of the cost of the wheel alignment machine under temporary full expensing. This is because entities with an aggregated turnover of $50 million or more are excluded from immediately deducting the cost of second-hand assets under temporary full expensing. Tiny's can still work out its depreciation deduction for the 21 income tax year in line with the usual rules. Tiny's can, however, immediately deduct the improvements to the wheel alignment machine under temporary full expensing. Tiny's first held the drop trailer before the 6th of October 2020, so it cannot deduct the drop trailer under the temporary full expensing rules. However, it can deduct the $50,000 cost under the instant asset write-off rules in its 21 tax return because its aggregated turnover is less than $500 million and the asset costs less than the $150,000 threshold and was acquired before the 31st of December 2020. Hopefully this has been helpful. I kept it short and hopefully you got some value from it and can work with your business and your accountants to prepare your returns and take advantage of the tax offices and government's concessions around COVID and their response to this. Again, Chris from Ryan, always happy to talk to you or your accountants around these rules or anything in the tax world, whether it's fuel tax credits, GST, or any other pressing issues. Thanks again and stay safe.